afternoon. They call this the graveyard session, straight after lunch. So hopefully we'll keep you entertained. And I think we're going to discuss something that's very topical, particularly in Asia, for people who are in the cash economy. Everyone talks about financial inclusion, and today I think we're very fortunate to have some CEOs and founders of companies that are right in the intersection of economics and technology. So the first panelist I'm very pleased to invite onto the stage is Mr. Peter Barcak, founder and CEO of Credolab. Our next panelist today is Mr. Patrick Lynch. He's the founder and CEO of First Circle. And our final speaker today is Mr. Mike Singh, who is the founder and CEO of Asiakredit. Okay, so I think we've got a great panel here, and I'll just do a really quick introduction, actually, and maybe I'll just pass on to each speaker just to do a brief introduction of your firm and your background. So just briefly about us, Fintonia Group, we're a venture capital and private equity investor. In the venture capital side, we focus on fintech. We have 6 portfolio companies, and we really focused, one area is around consumer and SME underserved consumers and SMEs, and the other areas around regulatory technology. So a little bit about us. Happy to pass to Peter.
Yeah, I'm Peter Barcak, CEO and co-founder of Credolab. Credolab is a big data company providing services to lenders to improve their ability to assess customers.
Thank you. Patrick?
So at First Circle, we use data to provide productive trade finance to SMEs. At the moment, only in the Philippines, but looking to go elsewhere in Southeast Asia through the course of this year.
Good afternoon, guys. Michael Singh, CEO and founder of Asiakredit. We are an end-to-end digital micro lender. When I say digital end-to-end, I mean fully digital. All the way from acquisition to underwriting to collections. And we are based currently in the Philippines, where there is a large underserved, underbanked market with plans to go regionally into Indonesia and potentially other markets.
Thanks, gentlemen. So I thought it would be useful just to dimension the issue for us all. And if we just take one country, Indonesia, as an example, but it is the same in the Philippines or many of the markets here. So in Indonesia, we have roughly 260 million people. People with a formal bank account is roughly 40%, so somewhere between 80 to 100 million people, right? But people, if we talk about financial services at a very basic level, access to credit or credit card or a loan from a bank, then only 8 million people in Indonesia have a credit card, which is roughly a 3% penetration. If we talk about small and medium enterprise, their ability to get an unsecured loan, we see data that suggests that up to 70% of SMEs are unable to get a secure, unsecured loan, to access to finance. If we talk about things higher up the value chain, such as wealth management, well, in most of these markets, there's very, very few people who are able to save for wealth management products. So I guess we'll just open this up to the first sort of question I have for the panel, which is, what does financial inclusion actually mean for you? So maybe we'll start with Mike and just say, from your perspective, what does financial inclusion mean?
Yeah. Well, I think all of us here kind of have a basic understanding of what it is, and forgive me if I repeat that. I guess financial inclusion, particularly for me coming from the Philippines, where Adrian talked about the large underbanked market in the Philippines. It's probably even more, there's even a worse situation in the Philippines where you only have 20 million bank accounts out of 70 million Filipino adults. And coming from the formal banking sector where I spent many years, including in the Philippines, I saw how banks really are, in emerging markets in Southeast Asia, in the Philippines specifically, are corporate lenders or lenders to the upper, the tip of the pyramid, the A and B segments, or wealth managers per se. And 70–80% of the population fall in the CD demographic, earning anywhere from $100 to $400 a month. And banks are very, very far away from even considering or desiring to touch this market. They just don't know what to do with them. They don't know how to score them. They don't understand them. They don't have deposits or any relationship with them. And yet, we know in the Philippines, 8 out of 10 Filipinos have the need for credit. We all have a need for credit, right? And who do they turn to? And they turn to informal lenders. They turn to loan sharks or pawn shops. So in essence, financial inclusion for me is the opportunity to deliver financial services. I have a bias towards credit to the underserved in countries like the Philippines and Indonesia, where you have a large part of the population that are in the bottom half of the pyramid.
Thanks, Mike. Well, I guess, Patrick, your business, which is SME financing, if you think I am a small business owner, I have a restaurant, perhaps I am a hairdresser. What does financial inclusion mean to the small and medium enterprise?
Yes, I think financial inclusion means opportunity. Financial inclusion means having access to the financial service, which ultimately is going to help them to get their business to the next level. I don't think financial inclusion means providing credit or making credit available to everybody, because unless you understand what it means to be a good credit, unless you understand that you have to repay in order to get up the credit ladder, then that can have a very negative, detrimental impact on the business. What we see is that the best way to go about creating an inclusive finance product is to help the businesses who are structurally underserved, and ultimately that has the biggest knock-on impact for themselves and also for the people that they employ and who they do business with.
That's true. I mean, that's very interesting. So access to finance, or credit in this case, in both cases, actually is perhaps access to dreams. It's access to something that you want. Well, two things that I just took out of the conversation there with Mike and Patrick was, customers, banks don't know them, structurally there are issues. So, that sort of comes to a question for, I guess, Peter. You're a big data company. We don't know who these people are. How do you help, I guess, slower, incumbent large institutions get to know their customers,
Yeah, I start with your first question.
Sure.
So for us, financial inclusion is sustainable access to financial services, which is beneficial for all relevant parties in the long run. And Credolab helps lenders to help them better assess their customers, because without proper tools, lenders will always try to lend to unbanked sector, and they're doing that all the time, but with not big success. And we saw a lot of portfolios that went bust, and we are here to help them to improve their ability to assess. And from customer perspective, for me, financial inclusion is not shark lenders or pawn shops, because this is not sustainable business for consumers, and they will not be able to participate in that scheme for a long time. And that's why it's really important to help people, to help unbanked customers to be part of a standard banking environment, so they can reach their dreams and aspirations and move forward.
Dreams and aspirations. That's very good. And I think that's ultimately, financial services is to help people, right? Help the community in some way. But let's just talk practically about, we always hear financial inclusion. People like to say, hey, I'm in financial inclusion, I feel good. Microfinance, for example, has been around for decades. Someone in the village would know somebody, give them a loan, the whole village would be responsible, particularly women who got access to finance to start a small business, and we've seen that. But we've seen low default rates, but we haven't been able to see a scalable, sustainable business out of microfinance, right? But we feel good. So if we want to make a sustainable change across and have impact across millions of people, then I think we have to use technology, right? Otherwise, we're reliant on people. So what I'm keen to understand is how does your company actually use technology to reduce barriers, to improve access to information, to sort of help people come into the system? So maybe Patrick, just share.
Sure, yeah. So I think it comes down to two things. First of all, the reason why small businesses don't have access to credit is because the current service offering requires either collateral or very long-standing relationships. So it's a relationship or a collateral-based lending environment, which structurally excludes a large number of businesses who have enormous potential, be that through the competency of the individual who's running the business or simply just looking at the trading patterns over a period of time. So what we do is we use that information in order to build a picture of the business, and effectively what we do is we make the provision of credit a meritocracy. The second thing that we do is, because we use the internet to distribute either through desktop or through mobile, the delivery cost is a very small fraction. It's approximately a tenth of what it would be for an existing financial service provider with a branch network and whatever else. And so what that means is that we're able to open up the addressable market very, very considerably, because we can serve shorter, smaller loans, which is ultimately what small businesses need, because our delivery cost is very low. So we open up a market by using information, we open up a market by reducing cost, and in short, then the addressable market becomes the tens of billions of dollars of unmet credit demand.
So let's just take an example of a bank. So if you had a bank want to do what you do, why can't they do what you do? So can you give me an example of a loan you give to an SME? How big is it in terms of quantum? How do they apply, and what's the difference between that and the approval versus, say, a bank?
Yeah, sure. So if an SME comes to us and let's say they have a purchase order which they're looking to be financed, and the purchase order has come from a relatively large company on which we can do a third-party credit check. The SME comes to us, they apply through mobile, and they will get a response within 24 hours, and they can be funded within 3 days from the moment that they apply. That's without any collateral, simply giving us the information. We'll run background checks, and on that we will then be able to fund them. If they go to a bank, they walk into a branch, they fill out the forms, they wait maybe 3-4 weeks for a response, maybe there are more forms. And as you can imagine, particularly if the loan duration demanded is 3 months, then for the bank, the customers have to wait 3 weeks. So it's...
Why can't a bank, and we have any bankers here, why can't a bank do a $20,000 loan in 3 days like you?
Because they're structurally not set up to do so. I mean, they have a branch network, they need to submit the forms to HQ, they then need to do the processing. For us, everything is loaded into what the customer is seeing. All of the processes are running in parallel as opposed to step by step. And what that means is we're able to basically compress the whole process and provide a customer with a $20,000 loan completely unsecured within 3 days.
Interesting. I mean, I've heard quotes that any unsecured loan for an SME for a bank that's less than US $1 million is not profitable for them. So there's a cost element there. So you're using technology and you're set up in a specific purpose way to sort of reduce costs. And what about, I guess, Mike, for Asiakredit? What's the typical, customer take from you? How do you, how do you use technology to reduce costs and make it accessible, this market?
Yeah, the beauty, I think, about technology is it really truly is the solution to financial inclusion. When you look at a firm like us, where our typical loan size is about $130, $150 US, there's absolutely no way a bank with their cost structure and different departments and risk and this and that can service that type of loan. The beauty as well about technology is the increasingly fast penetration of digital in the Southeast Asian region, particularly in the Philippines, where almost 60% of the population now have smartphones, and everyone is spending 4 or 5 hours on Facebook. I think we're the largest consumers of Facebook per capita in the world. So from our perspective, and I mentioned this in my introduction, it's a truly end-to-end digital process. In the Philippines, for example, we look at 3 parts of our value chain, from acquisition to underwriting to collections. On the underwriting side, we generate leads all through pay-per-click and SEM and that type of advertising. And in the Philippines alone, now every month there are approximately 200,000 searches for cash loans or personal loans on Google, and that's growing at a rapid clip. So we serve up our ads, and we obviously try to drive organic growth through word of mouth and social media. Once we bring in our leads, Peter talked about the power of mobile data in credit assessment. I'm sure all of you are familiar with that. That is showing, recent trends are showing that mobile data as a predictability of your behavior is much more powerful than demographic scorecards, for example, that banks are using. So using that on the credit assessment underwriting side, and then on the collection side, when you have a $130, $150 loan, you can't deploy field collectors, you can't really spend a lot of money before you start to lose more money. So on that side of the equation, we use a lot of big data, we segment the delinquent accounts, and we use a lot of robotics and automation, like automated dialers, IVRs, use of SMS and email. So that allows us to, really be cost efficient by using technology so that we can continue to generate a margin on a $100 loan that allows us to be sustainable.
I mean, that's interesting, Mike, because I guess we've seen disruption in multiple industries. In my old industry, classifieds and newspapers, and essentially where the profit pool is shrunk because a new technology player comes in, new business model. And what you're saying here is you're using technology basically to service a loan which would otherwise be unprofitable. I had a CFO of one of the major banks previously in Australia be my mentor, and he used to say, at least in Australia, that we will never, there are people that are not served because they are unprofitable. And maybe in Australia, maybe they don't need the financial services in the same way as you do here, but what I'm hearing is we're using technology to make them profitable by basically reducing cost. So I guess, Peter, what I'm interested, the other aspect we've heard is, look, we can do checks on the people can apply online, whether it's a SME loan, people can apply online and receive money through their mobile. I mean, that's a fundamental shift in consumer behavior in the last, decade. I mean, when did the iPhone come out, right? Since smartphones and so on. So we've got computing power, we've got consumer behavior. I guess what I'm interested in is when we think about consumer behavior and technology, Peter in Credolab, can you give us some practical insights to what's the sort of data that you use and you calculate to help big incumbent institutions try and lower their cost base and access this market?
Yeah, sure, Adrian. So technology is really a critical element. So we have developed that cool application called Credolab. Through that application, we can take clients' digital footprint and analyze that footprint because it's full. So usually a phone number, mobile device consists of 50,000 data points, of which we are able to analyze and see clients' behavior. So basically, by behavior, I mean, for example, how your inbox looks like in the morning, or your frequency of calls during the day. You're usually making calls during the day, during the business hours, or during the night, or duration of your SMS messages, or what applications you have installed on your mobile phone. Because everything is about clients' behavior. And using that big data, we are able to transform into a score, which is a probability of default. And we are able to provide a score to a lender, to any lender, within 60 seconds. So it means that we are able to help lenders to make fast decisions, but also decrease significantly their cost of risk and also expand. And this is what financial inclusion is all about.
Oh, interesting. So if I have a full inbox, I'm not going to get credit?
You know, that feature is just one of 10,000 that we are analyzing.
Yeah.
So it's really hard to predict that this one is good or bad. So it's a combination.
What if I have a lot of Facebook friends?
We are not doing that. We are not looking at Facebook because it's not allowed by Facebook. And we don't need to because our predictive power is so huge right now, just analyzing anonymous data. So we're not reading clients' emails or SMSs. We are not looking for particular words. We're just analyzing patterns. And this is so enough.
And it's interesting because what we're talking about is a shift in behavior. I mean, 10 years ago, no one really used a mobile, or 12 years ago. And certainly I recall when we used to run our mobile app that even in the Philippines and Indonesia, where internet is pathetically unstable, we still had 300, 400% year-on-year usage, 1,000% for mobile. So mobile is here to stay. Then I guess the other thought I had was when we think about technology and this data, I'd like to do a little poll just to understand what sort of technology we use. So in this panel, if your company uses this technology, can you raise your hand? Artificial intelligence. Yeah, asking you. Raise your hand. Artificial intelligence. 1, 2. I've got bad news for you, Patrick. They're going to have a higher valuation than you. Here's the next killer. Blockchain. Sorry, guys. Okay, there's a missing multiple. So what I might just do now, if the organizers are okay, is maybe just open up to the audience to ask questions. We've got some practitioners here in real life. Love you to ask something very practical, something that you've always wondered about how they do things, about what financial inclusion really means. How do you make money from financial inclusion? Ask them that. Love to hear. So is there anyone who would like to ask a question from the audience? I see one over there. If we have a microphone. Well, I'll ask the question in the meantime, and then we'll have a microphone over there, if that's okay. So maybe this is a little bit an uncomfortable question, but for me, financial inclusion on a sustainable basis means you need to make money, right? Sorry, we need to make money. So how do you create value, and how do you make money? How do you do that fairly? So maybe I'll pass to you, Mike, because you're a short-term digital lender. How do you make money, and how do you capture your fair share?
Yeah, I think, in an untested market, right? Peter said, and this is the case in the Philippines, banks have tried it and have been burned. And, there's a race to sort of crack the code. How do you service that, as Adrian called, unprofitable market? And I think the first thing is we can't be ashamed to price it right? If you're going to be a sustainable business, you have to price for it. It's kind of like insurance, right? The healthy people pay for the unhealthy people. So in our case, the good, responsible borrowers pay for the delinquent accounts. I think what's important, though, so I think that's the first point I want to make, is you can't be ashamed to price for it in order to build a model, understand your market, identify statistics or data on who the bad borrowers are and who the good borrowers are, so you can continue to build your business. And the second part I want to say is, as a responsible lender, you sort of have to, one is make sure once you've built your models and you can price it right, that you bring your prices down, right? So that you don't have a punitive pricing that is not feasible for the long term. The second thing I want to, building off that second point, is I think we have a responsibility to take that borrower that comes in a payday type of loan at a very high interest rate initially, and upon payment and repeat good behavior, that you graduate them into a more sort of advanced or sophisticated product, be it an installment loan at a more reasonable interest rate, right? And you bring them up the pyramid or up the curve, eventually leading them to become a banked customer and into wealth management, et cetera. So I think this idea of, we're gonna have punitive rates and just keep driving that repeat borrowing and drive that person into the ground. I think Patrick said that too. You gotta pick, right? You gotta be responsible and pick who you're gonna lend to and make sure that it's sustainable. You're graduating them, you're educating them, you're helping them come up the curve by cross-selling them into better products based on their behavior.
I mean, just what's interesting thinking about punitive pricing and how you discuss this is in emerging markets like in Southeast Asia versus, say, developed markets like the US or Europe, Australia, is what is punitive pricing? And to determine something's punitive means you actually need to assess and price the risk of the people that you know. And in these markets, we don't know. So that sort of talks about information. There's an information asymmetry. There's no national ID in some countries. So how do you overcome that? Well, we've got Patrick. Yeah.
Which, the ID question? Or?
Yeah, I mean, knowing your customer. So we have a question. Sorry.
This question is for Michael. How do you actually get the funds to a prospect? Since it's $150 and you're unable to send out an agent.
Yes, so we talked about technology, and so let me answer that question and then comment on it. What we do upon approval of a loan is we fund an electronic wallet. Electronic wallet in the Philippines and in other parts of Southeast Asia, electronic money is worthless, right? People need cash. There aren't payment points where you can pay in cash or pay electronically. Penetration of e-commerce is not that high, so our target demographic need cash. So we have partnerships with remittance and cash points across the country, whether it's a Western Union or a pawn shop. So that's still needed. That's sort of brick and mortar, right? And one of the things that, one of the challenges that we face is government and institutions building up, electronic money and interoperability between, retail outlets or banks or other institutions that can accept electronic money. But at the moment, we do tend to rely on a brick and mortar infrastructure to fulfill that disbursement of the loan.
There's a question over there. Yeah.
I've got a question. So if I take a look at what's going on in China with things like WeChat and Alipay, and you kind of look at what's happening in your markets, Gojek, Grab is coming in, how are you guys going to be able to survive when they start driving financial inclusion?
Good question. So maybe I'll pass to Peter or Patrick.
So I don't think that if you look at what's happening with WeChat or you look at what's happening in Indonesia with Gojek setting up a payments platform or Grab most likely going to be trying to do the same in 2018. And it's a very small part of what the overall value chain or kind of product demand that a consumer or a small business has. If you look at how financial services have played out in Europe or the US, where you have much greater degree of specialization on certain elements, and ultimately then building excellent service delivery within those products, then ultimately what the proliferation of, for example, Gojek and payments in Indonesia is just the rails to be able to deliver the service better. And I think what you'll find is that these platforms don't want to take on all of the services themselves, because at some point it becomes impossible for them to do that efficiently. Being the platform very much means that you link the consumer with the end product, like you're seeing with, for example, the digital banks in the UK. So I think what you'll see is that these platforms will be more open to service providers, helping them to deliver a better quality service to the end consumer, because ultimately if they have the best value proposition, then they will be able to hold the consumer relationship, which is ultimately their core KPI and what drives value for them.
Interesting. I mean, we're talking about disruption of tech companies, right? We're talking about ecosystem platforms being able to provide multiple services. So I think we might have time for one more question. I thought I saw someone over there in the spotlight, but I could be wrong. If not, I might go back to asking one of my questions. No? No questions? Okay. I guess the last question we have time for really is just to think about, if you were to think 5 years' time, how will your company actually help financial inclusion? What would success look like for you? So maybe I'll just hand that to Peter. You can leave us with our hopes and our dreams.
So the measure that we can take and look at 5 years would be penetration of public debt. So currently in Southeast Asia, where Credolab is present, it's comparing to other countries, developed countries, it's pretty much low. And the reason behind we have already discussed. And I see this region to be a much higher volume in terms of penetration in 5 years. And this is purely because of utilization of big data, which is happening big time in Southeast Asia right now.
So we're looking over at a macro level of consumer finance, SME finance as a percentage of GDP. So look, thank you very much. I'll just sum up what I've taken notes out of this. So if we think about financial inclusion, for us in the panel, it means helping people achieve their hopes and dreams. And the first step for that is access to credit. We haven't talked about insurance, we haven't talked about wealth management, but certainly as a first step, building block for financial inclusion is actually having access to money. I think the second thing that I took out of this is that technology is utilized to take cost out of the system. And that's what's going to be very different or difficult for incumbent institutions to do. And the final thing I've taken away is that consumer behaviors, business behaviors fundamentally change. It's fundamentally online. And because it's gone online onto mobile, that's a new paradigm for everybody. So please join me in thanking our panelists for a great session on financial inclusion. Cheers.
Thank you.